Hi there, welcome to Market Call. For the hour, David Burrows is on our show. He's President and Chief Investment Strategist at Barometer Capital Management. Great to see you.
Great to be here.
Let's put that number up on the screen. David is here to take your calls, emails and tweets on North American large caps. There's the toll-free number, 1-855-326-6266. We need a jingle for that thing. Maybe somebody could send in a little video. Putting it to music, our phone number. You can also send in video questions. You know that you can send in video questions. Will you? That's another question. Very simple. Just film a quick 30-second question, attach it to an email, and send it in to marketcall@bnn.ca. David, you're here with what sounds like a reassuring message. You reckon that we're completing a correction in a long-term bull market.
Right. So I think it's a really confusing time for people right now, especially given the markets we've been through over the last few years. And if you read the press, there's all kinds of negative stuff and things to worry about, from China to emerging markets to commodity production, all sorts of different things. And there's a few things that we have to remember. In order to get to the late stages of a correction, there's got to be a lot of stuff we've been worried about, right? Just like when you get to the late stage of a bull market, it's got to feel pretty good.
Okay, yeah.
Okay, and you know, just interestingly as a side note, if you look at the percentage of bullish individual investors in the U.S. as of 10 days ago, 17% of investors. Now you have to go back.
Sorry, 17%.
17 of investors in the U.S. are bullish.
So that's
meaning the rest are either undecided or bearish.
And that's a good sign for the market.
If you went back in time, you have to go back to the second after the crash in 1987 to have had that few bullish investors. If you went back 10 days ago and looked at short interest in the NYSE or the amount of short selling that was taking place in the market, the only time in the last 15 years you got close to that was at the height of the crisis in 2008. And again, that was for a second. So, you know, people have learned to be more tactical in their investing and picking their spots. And we run a process that tracks what people are actually doing. And we track the percentage of stocks within various markets that are behaving well or making higher highs and higher lows, as they should be if things are going well. And I've got that tracked back about 60 years. And in the course of the last 20 years, there have been 5 occasions where the percentage of stocks in New York that were performing well got to below 30%, meaning very few stocks were doing well. In every one of those 5 cases, when that percentage started to rise or stocks started to show reversals, it was time to put money to work. So to put it in context, as of 10 days ago, 20% of stocks in long-term advances. To have seen that level, you have to go back to October of 2011, and we remember that was the height of the European crisis. And before that, you have to go back to March of 2009. Before that, you have to go back to the worst point in the tech wreck, and before that, you have to go to the Asian crisis in 1998.
So these were market bottoms.
These were multi-year market bottoms. Now, we've seen that reversal take place in the last week in that percentage. So we've said for some time we believed we entered a new long-term bull market for stocks at the end of 2012 when we exceeded the highs from the year 2000.
Maybe we could put up a 10-year chart for the
that would be really useful.
S&P 500?
Even a 15-year chart would be more useful.
S&P 500 maybe?
Right, S&P 500 would be perfect. And we exceeded those highs in the end of 2012, and we started to see multiples for stocks expand. At the end of those long, difficult markets,
so there, and sorry, David, just back up there. So what was the time frame again?
We really need sort of the Dow or the S&P from 2000 until 2012.
Okay, right. So we're going back about 10 years.
Right. If you go back to 2000.
I beg your pardon, David. That was 15.
Yeah,
carry on.
That's right. So when we exceeded the highs in 2012, we believe we entered a new bull market for stocks. You hadn't seen multiple expansion in 12 years. Now, lots of people are negative having gone through a world like that and worry about corrections. The last time you came out of a long-term bear market in 1981, the market rallied 2.5 years. Then it had an 11% correction over about 7 months. And everybody got concerned. We were going back in the glue. And the market turned and rallied 150% the next 2 years.
That was the Reagan rally in part.
And if you go back to the beginning of the secular bull market that started in the 1950s, the market broke out in 1951. 2 years in, the market pulled back 9% over 7 months. Everyone got concerned, turned around, and the market rallied 100% in the next 2 years. So we believe that we're headed into a much better environment, and there's going to be some very clear winners. It is a scary environment for people. You have to take emotion out by having some process.
And that's the time to invest when it's scary.
That's right.
David Burrows will be right back. He's taking your calls. He's President and Chief Investment Strategist at Barometer Capital Management. The topic today, North American large caps, 1-855-326-6266.